Hi guys, last time we compared whole life insurance and universal life insurance. Notice that they both belong to permanent life insurance. Okay, remember we said that the universal life has three flexibilities. One is that the premium payment is flexible. You could be paying $100 this month. Next month you could be paying 110 or $95. That's one flexibility. The second one is death benefit flexible. You could be buying a $500,000 policy, but if you withdraw money, too much money, and then you could make it for like a $400,000. So it could be added to like make it $600,000. So this is all flexible. The number three flexibility is the investment flexibility. We have the policy holders have more flexible to what kind of investment they want to make. So today we'll talk about compare the whole life insurance, permanent life insurance, and the term life insurance. So term life insurance and permanent life insurance is like one is renting a house, another is buying a house. So renting the house, you have a famous saying that you use it or lose it because when you buy a term life insurance, if you died before the term is up, your loved one, your family members will get all the death benefit. But death benefit is all you get. There's no cash value. There's no equity. But if you are buying, that's why you said it, that use it or lose it. If you survived 20 years, 30 years, you did not die, then the policy just ended, and your loved one, your family member, got no penny, not even a penny. So that's the risk you have to take. Although most likely most people will convert it, the term life to a permanent life insurance before your term life term is up. So, but here there's another very important difference between term life insurance and permanent life insurance. Remember, permanent life insurance include whole life insurance and universal life insurance. Within the universal life insurance, we have several types. We have a traditional universal life insurance. We have like a index universal life insurance (IUL), and we also have a variable universal life insurance (VUL). So that's something that we'll talk about, but another time. But this time, let's compare term life, because when you're young, it's actually a good idea for you to get a term life insurance first, and then later convert it to permanent life insurance. Okay, so but the difference between if you are only buying the term life insurance, you don't have to worry about the cash value because there is zero cash value. All you get is death benefit. If the term life says, if you died before the term it's up, then the term life, you have a $200,000 term life. That means your family members will get a $200,000. That's it. If you do not die, zero. No, nobody get any money. Okay. So but here, there's another difference is that term life does not have cash value, but a permanent life insurance always have cash value. It's like a savings account because you have equity. You are buying a house, so you got equity, and then part of the benefit you get is from the cash value. So there are two kinds of usage for cash value. You could, of course, everybody knows that the death benefit is only for the loved one, only for the people that after you die, right? So those are the death benefit is for others. Cash benefit could be your living benefit. There, meaning that you could use the cash value for yourself for various situations. For example, there's something called accelerated death benefit. Typically, it means that you are like a former President Jimmy Carter, right? He just passed 100 years old. So he's still living this long. So, but if he want, he could get a part of his life insurance benefit to himself, to cover himself, right? For like hospice care, for example, right? So that's one use of it. Accelerated death benefit, typically used when the doctor says that you only have 12 months to live. But that's not have to be the case. Sometimes it depends on the policy, depends on the insurance carrier. Sometimes you are, you know, bounded in a nursing home. Then some policy will allow you to use some of your cash value for yourself, to take care of yourself, right? So that's one type. It's called accelerated death benefit. Another one is that long-term care. If you have like a chronic illness, or even if you don't have a, because chronic illness is a medical condition. Sometimes you're still fine. You are just too old. You cannot take care of yourself. They have like something called activity of a daily living (ADL). So if you cannot do that, including eating, you cannot feed yourself, including the taking a bath, including the transportation, those kind of things. If you can do two or three of the activity of daily living ADL, then you may need somebody to a permanent caretaker to take care of you. That money could come from your cash value, right? So the other things, like for example, if you're a terminal ill, you're chronic ill, critical illness, those all can be used. The money can be used for yourself. That's why we call it living benefit, because it's not a death benefit. Death benefit, remember, is designed for the loved one. Living benefit mostly for yourself. You can take care of it. So here is the issue. Because you have some cash value in your policy. So there's one important usage for that is that you can borrow the money. So that's where everything get complicated. Because if it's a term life insurance, no cash value, nobody worries about it, because the only use for your term life insurance policy is for your loved one. But once you have a cash value putting in it's basically like a savings account in a bank. So except that this one, there are several advantages if you decided to borrow money from your cash value. Let's say you have the first one is that the money that you borrowed from your cash value. Let's say you have a 500. Let's say you have a $300,000 cash value. You could borrow up to 90 or 95% of that $300,000. The insurance company will allow you to borrow that much money. But obviously, you don't want to overborrow it, because once you overborrow it, let's say you have $300,000, but you want to borrow $400,000, then you might get into trouble because your policy may be lapsed, meaning the policy will be ended. You're no longer in force. It's no longer effective. Then IIS will come to get you, right? So like in this case, that let's say you paid your premium up so far, you paid like $300,000 so far. That's almost unlikely, because your premium don't pay that much, right? Because the idea is that using your money, using the premium money, invested the premium money, and then get more coverage for your death benefit and the living benefit. But let's say you put in $300,000 profit premium, and then you can anything. If you like, remember we said that the $400,000, that much money, that difference between $400,000 and $300,000 will be taxable. But otherwise, if you borrow within your cash value, it's not considered taxable. Basically, why? Because basically you're borrowing your own money. IIS would think that you're borrowing your own money, so they won't charge you, right? Not only that, but if you're borrowing from getting a policy, we call it a policy loan. If you're getting a policy loan from your cash value, unlike other, business loans or personal loans or credit card loans, two major benefits. Number one, the interest rate is much lower. Remember, if you look at your credit card statement, if you borrow from a credit card, it could be 18%, it could be 20%, or 22%, right? Interest rate is very high. But even if that, even if you borrow that not from a credit card but borrow from the bank, your personal loan typically will be, or business loan typically will be like 12% on average, right? But in your case, if you're borrowing your policy loan, then the interest rate is typically less than 10%. It's about, I think, it's anywhere between like 6%. So, and also they never check your credit history. Remember, this cash value is your money. Okay, so borrowing from your cash value is not considered borrowing the same thing borrowing from the bank. So unlike the bank, they will check your history, they'll check your credibility, they'll check your credit score. But if you're borrowing from your own policy, nobody checks that. That's two major advantages. So let's stop from here.